Vinay, hi, good to be speaking with you. Thanks so much for making time and speaking with us. To begin with, this is something that we have been talking about a while, that the Indian markets had, had run up ahead of the fundamentals, and now we're seeing this correction. But how long do you anticipate this correction to last, and how much deeper can it really get and for the markets?
Hi, good afternoon, Anisha. Thank you for having me on your show. So I think it's pretty difficult to predict the near-term movements of the market. But suffice it to say that we have borrowed some returns from the future, at least in the near term, from a near-term perspective. So I think it is healthy that the market does witness some correction. We could also witness some time correction, if not price correction, and I think that will make the markets much more healthier and much better from a long-term investor's perspective.
Now, this correction in market, there are two broad reasons that have been given. Firstly, is the stretched valuation. Second is the weak set of numbers that we are seeing coming in the second quarter. In fact, the net profit growth that we are expecting in the second quarter is the lowest in the last 17 quarters. But do you think, or do you think this earnings weakness is just temporary, and second half we could see a strong recovery? What are the key things that you are seeing in the second quarter numbers that have come so far?
Sure. So I think you have raised a very relevant point. The second quarter numbers have clearly been very disappointing, and it has been multiple sectors that we have seen such disappointments. We have seen challenges in segments like microfinance, segments like retail lending, unsecured lending, consumer sectors, particularly discretionary, even in staples. Some of these commentaries which we have received from the management is pretty cautious. So I think while there is a big expectation of improvement in the second half, one needs to approach it with very, very cautious optimism. We think that we could see some more earning downgrades for fiscal year 25, and that could continue for some more time. But definitely some softness which is visible from the second quarter.
Definitely visible, but on a risk reward basis, and when you marry the valuations with growth, which are the sectors that you still find deep value in, if not deep value, at least reasonable?
Yeah, sure. So on a relative basis, we think that sectors like IT are reasonably attractive. The sector is turning around. The valuations are reasonable. There are companies which are growing at a reasonable pace. So that's an attractive sector. We like private sector banks within financials. We like private sector NBFCs. These are companies which have pretty long-term track records of sensible lending, and they are still available at reasonable valuations. Remember, the deposit-related challenges are probably also behind us. So that's another sector. And third, and most importantly, we think a healthcare sector presents a multiple-year growth opportunity. This is a sector where the valuations are fair, growth is pretty high, and there is a structural opportunity in this sector. And finally, we like telecom as a sector. Once again, a reasonably good growth sector available at some reasonable valuation. So I think net, these are sectors where we think there is opportunity on a relative basis.
Just wanted to deep dive into the comment regarding the fact that you prefer NBFCs over banks, because from a lot of experts I've heard the other way around, that they're preferring the banks versus NBFCs, whether it's the RBI action on some of them, whether it's the asset quality issues on certain MFI and unsecured book. What's making you a bit more tilted towards NBFC versus banks?
So it is not NBFC versus banks, Anisha. I said we are positive on private sector banks and NBFCs. Remember, NBFCs are a very varied lot. They are not homogeneous, but very, very heterogeneous lot. There are a large number of very good quality NBFCs which have solid managements. They have historical track record of lending sensibly. So you need to separate the wheat from the chaff. And there is a pretty good picking ground from the NBFC segment. So there are a large number of NBFCs which are listed. So we need to pick a few of them which are lending sensibly. I totally agree with your point. There is a challenge within the sector. Retail lending sector is seeing challenges, particularly microfinance. So we need to be very cautious. But on a risk-reward basis, this is a sector where there are opportunities.
On one hand, the entire market is worried about the expensive valuations, but you seem to be quite positive when it comes to mid and small cap. And despite this correction, I don't think the mid and small cap valuations are still lower than their averages as compared to what we are seeing when it comes to large cap. So why this bullishness when it comes to the mid and small cap?
So we are positive on mid and small cap, particularly companies which are growing fast. I think when you look at the returns over the last 1.5 years, there is clearly a very big difference between high growth small and mid caps and low growth or cyclical small and mid caps. Last 1.5 years belong to low growth and cyclical mid and small caps, wherein they have delivered significantly higher returns compared to high growth ones. And I think the opportunity lies in those high growth small and mid caps. And these are companies which have structural tailwinds behind them. And these are companies which ought to trade at a much higher fair multiples and hence are still available at not very expensive valuations, but still reasonable valuations, such that potential returns over the medium to long term still remain reasonably attractive.
Let's watch out for those spaces, and at least the long-term, prospects still look smart. Thanks so much, Vinay, for making time and speaking with us today. So that's the view coming in. There could be a bit of a time-wise correction that we have at our hands. For